QuickBooks Pro Desktop 2021. Multiple currencies, purchase inventory on account, meaning purchase inventory not for cash but with accounts payable, increasing the liability of accounts payable. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our multiple currencies practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. Now we're going to be purchasing inventory. We're going to be purchasing inventory on account, meaning accounts payable is going to go up. Not only that, but we're going to be paying the accounts payable in the future, not in our currency that we measure our financial statements with, in our case, the US dollar, but in a foreign currency. Now, typically, when we have the purchasing of inventory, or when we purchase most things on account, we will enter the bill. Now, also note that as we think of the inventory, we're not going to be tracking the inventory items in the system, the units of the inventory using the average inventory method. We're just going to record the purchase of the inventory and record that directly to the account because our focus here is going to be in on the foreign currency transaction related to the accounts payable. So we're going to enter basically a standard kind of bill when we purchase something. It just happens we're purchasing inventory at this point. We would normally do that by entering the bill, which would increase the accounts payable. The other side then going to what we're purchasing, in this case, an asset of inventory. And then at a later point, we would be paying the bill at this point. And then we might have an interim kind of transaction that would need to take place in this case, given the fact that we're actually going to be paying this off in foreign currency. So we have the added complication of, one, when we enter the bill, we got to make sure that the enter the bill with the current spot rate to record it at the current value. And then if we might have to revalue it at the end of the period or the end of the year or month, and then we've got to pay it, which might have a different spot rate. Let's take a look at this first in Excel, and then we'll get back here and enter it into the system. The scenario then is that we're going to be purchasing inventory. We're going to be paying for it in the future, therefore increasing the accounts payable. We're going to pay it in the future, not in US dollars, but in the British pounds. So it's going to be abbreviated by GBP for the British pounds foreign currency. So the transaction is going to be straightforward. If we buy the inventory on account, we'd have the same accounts that would be affected, which are the ones that you would expect, meaning we're going to increase the inventory. That's what we got. And then the other side is going to be going to an accounts payable, but we want to show that this is an accounts payable that we will be paying not in our currency, but in a foreign currency. Then it gets a little bit tricky in terms of how we're going to record this on our books. We're going to be paying 20,000 foreign currency units, pounds in this case, but we are going to record it on our side in the equivalent units as of the point in time that we purchased it, even though we're not paying it to the future. In other words, you might say, hey, look, I should put this on the books basically for what we think the value will be when we actually pay it. No, we're going to put it on the books at the current exchange rate today, even though we're not paying it until the future. And then if there's a change in the exchange rates from now to then, which there will inevitably be, we will not revalue the inventory, but rather revalue the accounts payable and then put the other side to gain or loss on the currency transaction. So we're going to be taking then the pound here, the 20,000, and we're going to value it using the current rate, which we'd call the spot rate, the exchange rate at this point in time, 1116, which is 1.65. So we have 33,000 equivalent dollars to the 40,000 or the 20,000 pounds we will be paying some point in the future when we pay off the payable. So that's going to be the debit and credit. So we're going to record our inventory on the books then for simply that US dollar equivalent at the point in time that we made the purchase, even though we haven't paid for the purchase yet, and we'll be paying in the future, which will have a different spot rate. And then we've got the accounts payable on the books at that point in time. So in the future, in the cutoff date, we'll have to have a change possibly in the accounts payable as time goes by and the exchange rates differ. So then we're going to try to do this in QuickBooks now. So with QuickBooks, we're going to put the inventory on the books. That's fairly straightforward. We're just going to journalize it. We're not going to go through the units of inventory to track them using like average or first in, first out. Weighted average would be QuickBooks typical method. And then we have, in the desktop version at least, but then we have the accounts payable that will be going up, and this needs to be in the pounds, the British pounds. So we need to make sure that we have a payable set up that is in British pounds so it can help us to track the changes in the currency exchanges. So if I go back on over to QuickBooks, I'm going to go to the lists drop down. I want to take a look at the chart of accounts, and we have an accounts payable in yen and Canadian dollars, we need one in pounds now, because now we're dealing in pounds. We're wheeling and dealing all over the world here. So we're going to say we want a new item. So we're going to say rise up, new, and then this is going to be, oh, before we do this, just note, you might need to turn the currency on as well. So we might want to go to the currency lists first. So we go to the lists drop down and then go to the currency lists. And so these are the currencies we typically have. And the British pound is not one that's there basically by default. So I then say, okay, I want to see the inactive items. I'm going to browse by the code over here because that's, and I'm looking for GBP. So we're going to say, scroll on down. There it is. So the British pound sterling, that's the one we want. That's the one. I'm going to right click on that. I'm going to make that a active. So it's active that means the little checkbox goes away. And then I'm going to uncheck this so we can see the active items. There it is. Now that it is there, let's set up an accounts payable linked to it or related to it. So I'm going to go back over to our chart of accounts now, set up an accounts payable account for the British pound sterling. So I'm going to say new, so account rise up, new. We want to say this is going to be an accounts payable type of account, AP, accounts payable type. And then we're going to say that this is going to be accounts payable, and then this is going to be GBP, British pound sterling. I would think that would be Great British pound, but in any case, we're going to hit the drop down and British pound sterling, okay, shouldn't it be Great British pound sterling, British pounds GB? Anyway, so we're going to go ahead and save that. So I'm going to save that. So the next thing we want to set up is the exchange rate that we're going to have as of the point in time that we do the transaction. And then we need to set up a vendor that we're going to be dealing with, making sure the vendor lines up as a vendor who we pay in the foreign currency. So we have to have those things line up. So I'm going to go to the lists drop down and let's go to our currency lists where now we have the British pound sterling. Now, if we were to do this transaction today, then we can just say, okay, I need the current spot rate, go into the activities, rise up, and we're going to then go download the latest exchange rates, please. And then there we would have it. It would just give us the current exchange rate for the pound. And so I'm going to double click on it, though, this being a practice problem. And we're going to enter in a future date manually for the practice problem, which is going to be 11/16 x21. So I'm going to say 11/16/21. No, the 1.65. That's the 1.65. So 1.65. Then I'm going to say OK. Now the next thing I'm going to do is set up the vendor, which we could do as we enter the information into the bill. But I like to do it here just so we can emphasize the fact that these things need to line up. The vendor needs to line up. So I'm going to go to the vendor and I'm going to say that we need another vendor. So drop down, new vendor, and I'll call it vendor 3. So this is going to be vendor 3. And I'll just say this is for the GBP, vendor 3 GBP. And that's going to be their name. That's the name of the vendor. And I want to make sure that it's not a dollar over here. This is going to be for the British pound sterling. And so we're going to then say, okay, so that has to line up. The British pound sterling for the vendor needs to line up to the accounts payable when we enter the bill. So now we can go ahead and just click on that bill item. So we're going to enter the bill. And the bill means that the accounts payable is going to go up. It's currently going to the accounts payable for the Japanese yen. That's not what we want. We're talking GBP at this point. And then we're going to say that the vendor is going to be vendor 3 GBP. And the date is going to be for 11/16/21. 11/16/21. And we've changed the date, so it's going to change the rate down there from the current day to the rate that we just put in for that date. And so there it is, 1.65. That looks good. The amount in terms of in terms of the GBP, British pound sterling, is going to be the 1.65. The amount is going to be 20,000. 20,000. So 20,000, which transfers to the 33,000 for us. That looks right. And then the other account, I'm just going to put it into inventory. Now, again, we're not tracking inventory in the system. If we were, we'd have to set up inventory items. I'm just going to put it directly into inventory, which I'm going to set up by typing it in there, set up the account, and then I'm just going to put it into an other current asset account. Other current asset and continue inventory. Notice we don't have any currency thing we're going to set up because we're going to value our inventory in the units that we value our financials in, this being the US dollar for us. So I'm going to say save on that. What's this going to do then when we record it? It's going to increase the bill that's in a foreign currency. That means accounts payable is going to go up because it's a bill. So accounts payable is going to go up. It's going to increase the AP for the GBP. And it will do so not for the 20,000 GBP that we will actually be paying in the future, but for the US equivalent given the current exchange rate, or in our case, 33,000 at this point. Then the other side is going to be going into inventory and valuing it at not the 20,000 pounds that we're going to be paying. We're not valuing it in pounds. We're valuing it in the US equivalent, which is the 33,000 here. So I'm going to say save and close and check it out. So save and close. Now let's check it out. So I'm going to go to the reports drop down, company and financial. We'll go on down to that balance sheet standard. I hit the wrong button. That's the wrong report. Closing that out. Hold on. Bear with me. Company financial down to the balance sheet standard. Then we'll change the dates up top, customizing the reports from 01/01/21 to 12/31/21. Say OK. And then we have our inventory on the books for the 33,000. Note that that's the inventory. We're recording the inventory now, even though we haven't paid for it at the current spot rate today. And we're not going to be adjusting it in the future, even though when we pay the 20,000, I believe it was 20,000 British sterlings in the future, the spot rate will be different. So we're not really going to change this inventory typically. Instead, down here, we have the accounts payable that it will then possibly change. So we're going to have, we could change it basically at the end of the year if there's a cutoff, or when we pay it, because we will have a difference within the spot rates. When we change that to the new exchange rate on the spot rate, the difference between the two spot rates will result in a gain or loss on the income statement rather than a change to the inventory. So we'll see that in the future. If we double click on any of these items, of course, that'll take us to the bill here. Closing this back out, back to the home page. Now, we could just go from the bill to the pay bill, and that should record that change in the spot rates that will take place and the gain and loss that will be related to it. But we might have that cutoff issue in the middle, which we will define a little bit more, a little bit better this time, because we'll actually look at a situation where we haven't paid it till after the year. So we'll have this cutoff situation at December 31st, and then we'll pay it in the following year, and then think about, well, what do we do with the gains or losses that we need to be breaking out before the cutoff and after the cutoff, and we'll deal with that with adjusting and reversing entries.